Welcome to the Deep Dive. Today we're opening a file on a theory that, well, it's so fundamental to modern economics that once you see it, you can't unsee it.
It really is the key.
We're conducting a forensic investigation into something called the Cantillon Effect, and we're going to treat this 300-year-old discovery as the unified theory of why you might feel poorer, even while the headlines are screaming that the economy has never been better.
Yeah, and this is probably the single most important concept that's, let's say, intentionally left out of any standard financial education you might get.
Right.
For the honest, diligent worker, someone who's just playing by the rules, working hard, saving money, this deep dive is going to be a profound explanation.
So if you feel like you're running faster and faster just to stay in the same place.
It's not a feeling. It's a measurable, predictable, and systemic effect. We're basically analyzing a financial machine that acts as a huge, invisible transfer of wealth.
Okay, so let's set the stage here. Let's unpack this central mystery. We're calling it the paradox of 2025.
A good name for it.
You look around and there's never been more technology. We've got AI, automation, global supply chains. All of this should be driving costs down and productivity up, right?
Logically, yes.
Corporate profits are at record highs. The stock market seems like it can't lose. Luxury cars, watches, they're selling out months in advance. And yet, for the average family, a trip to the grocery store is stressful. The cost of housing, of education, it feels suffocating.
And that creates a cognitive dissonance. It's genuinely confusing. How can both of these things be true at the same time? How can you have this booming wealth at the very top and this relentless erosion of living standards for, the middle and the bottom?
The official explanation is always what? Wage stagnation, the temporary problem.
Yeah, mainstream commentators will often just dismiss it. It's a glitch. It'll sort itself out.
Yeah.
But our sources argue, and I think pretty forcefully, that this is not a random bug in the system.
It's a feature.
It is a feature. It is an observable outcome, determined by a law of monetary physics that dictates where new money goes and how fast it gets there.
And the culprit, the name for this whole mechanism, is the Cantillon Effect. We're reaching all the way back to the 18th century to an Irish banker and speculator named Richard Cantillon. He figured this out around 1730.
And the core idea of the Cantillon effect is, it's absolutely revelatory. It says that when new money is injected into the financial system by a central bank, doesn't matter if it's printing paper or, creating digital dollars, it is fundamentally not neutral.
So it doesn't just spread out evenly?
Not at all. It doesn't raise all boats. Instead, it acts like a vector. It's an unequal tide that systematically transfers purchasing power from the people furthest away from the money's entry point over to the people who are closest to it.
And if you don't grasp this concept,
if you don't grasp this inflationary vector, as we'll call it, you will never, ever understand why saving your money in cash feels like a guarantees losing strategy in the world we live in today.
Okay, so our forensic mission today is clear. We're going deep into the plumbing of the system. First, we're going to establish the historical precedent. What did Cantillon actually see during the first great monetary experiment, the Mississippi bubble?
Then we'll get into the modern application. We're going to use a waterfall analogy to dissect the physics of inflation, tier by tier.
After that, we conduct a data audit. We'll show you the mathematical proof, what we're calling the Cantillon gap. And finally, we'll wrap up with the smart money playbook, basically. The necessary counter strategy for positioning yourself upstream.
All right, let's start at the beginning then. Section 1. Historical precedent. What did Richard Cantillon see 300 years ago that everyone else missed? And why does it matter so much today?
Well, it matters because the basic mechanics of human nature and political power, especially when it comes to money, they just don't change. And Cantillon himself is a critical figure here. He wasn't some, cloistered academic in an ivory tower writing theories.
He was in the trenches. He was a highly successful international financier, a risk taker, a speculator who was deeply involved in the machinery of wealth creation in 18th century Europe. He had skin in the game, and maybe most importantly, he had the connections to be positioned right near the source of power.
And that insider perspective must have given him a pretty unique vantage point. He could see what happens when a government just decides it can print wealth into existence.
Oh, absolutely. He was active during maybe the most spectacular early example of a fiat currency mania, the infamous Mississippi bubble in France. This was orchestrated by a Scottish financier named John Law, starting around 1716.
So what was the situation in France at the time?
France was broke. They were deeply in debt from wars, and John Law comes in with his radical solution. He says, let's replace gold and silver with paper banknotes, issued by my own private bank, the Banque Generale.
And the promise, I imagine, was pretty seductive.
It was revolutionary. He promised that by increasing the money supply, they could stimulate trade, pay off all the national debt, and basically make everyone rich. They genuinely thought they had found the secret to perpetual prosperity.
Wow.
And the initial results were intoxicating. Law tied this new paper money to the prospects of his Mississippi Company, which had a monopoly on trade in the huge Louisiana territory in America. So as he printed more and more money, the stock of the Mississippi Company just went vertical.
And people thought they were becoming incredibly wealthy overnight.
Fortunes were being made and lost in hours on the streets of Paris, and Cantillon was right there in the middle of it all, trading, but also observing this fever pitch.
So let's trace the flow here. The government creates a fresh supply of paper money. It pays off its old debts with this new paper, and the stock market, the Mississippi Company shares, skyrockets. What did Cantillon notice about where that new liquidity was going?
He noticed it wasn't a random cloud of wealth. It didn't dissipate evenly over the whole country.
Right.
The flow was highly directional. The new money was first handled by the Royal Treasury, the high financiers, and John Law's immediate circle of courtiers and insiders. They got their hands on this paper money first.
And at that moment, it still held its original high purchasing power.
Exactly. It was pristine, undiluted. And what did these insiders do with this brand new currency?
They spent it.
Immediately. On assets. They bought up shares in the Mississippi Company before the prices had fully exploded. They purchased huge tracts of land. They bought luxury goods, fine carriages, diamonds, estates. They were capturing that initial wave of purchasing power, converting the paper into hard assets.
This is it. This is the moment of discovery. The king's friends got the purchasing power. They used money that was, for them, cheap to buy assets before the system even knew what was happening.
That's precisely it. The key concept that Cantillon isolated was the time lag. It takes time for new money to circulate through an entire economy and start affecting the prices of everyday things. Bread, clothes, tools, labor.
Velocity of money.
Exactly, and it's slow. So as these insiders were spending their new money on assets and luxuries, where did that money eventually end up?
Well, it trickles down.
It trickles down through secondary purchases. The people who built the courtiers' new mansions, they got paid. The tailors who made the expensive clothes, they got paid. But, and this is the crucial part, by the time this money reached the vast majority of the population, the farmers, the laborers, the artisans, two things had already happened.
Okay, what were they?
First, the price of necessities, especially food, had already started to rise significantly because of all this new demand. And second, the assets, the stocks, and the land the insiders had bought were now priced completely out of reach.
So the outsiders, the common workers, the peasants, as the outline calls them, they got their wage increases last. And by the time the money got to them, their cost of living had already shot up.
Precisely. They got the inflation. The insiders got the purchasing power. And Cantillon watched the whole thing collapse. He saw how those who got the money first sold their high-priced assets for even newer paper money, getting out right before the currency collapsed and bankrupted everyone downstream.
And his book, The Essay, basically wrote this all down. It codified the observation that money is not neutral. Where it's injected determines who gets rich and who gets poor.
It establishes the Cantillon Effect as this foundational law of monetary distribution.
That historical context is so important. It confirms that the inequality we see today isn't just a modern political problem, it's a structural inevitability. It's built into any system that allows for this kind of central money injection. If you're downstream, you're always at a disadvantage.
Oh.
Okay, so let's pull that historical insight forward into our modern financial system, Section 2, the unified theory, the waterfall analogy. We need to visualize the physics of inflation as it works right now, with the Federal Reserve and its tools.
This is the perfect analogy because it gets right at the directional flow. You have to forget this myth of the helicopter drop, that money is just randomly scattered across the economy. It's not.
It's engineered.
It's completely engineered. You have to imagine the central bank, the Federal Reserve, standing at the very top of this terraced waterfall, holding a massive hose. And it's pouring trillions of dollars into very specific, very precise conduits.
So let's start at the top. Tier 1, the source. You called it the antique Goldwater, who is positioned right there at the spigot in today's economy.
This is the absolute top. This is the primary dealers, the largest commercial banks, and the treasury market. When the Fed decides to do something like quantitative easing or QE.
Which is just a fancy term for creating new money.
Essentially, yes. It doesn't print physical dollars and hand them out. It digitally creates bank reserves, and then it uses those reserves to buy assets, usually treasury bonds or mortgage-backed securities, directly from these very large banks.
So the Fed is trading brand new digital money for assets that the big banks are holding.
Correct. The banks are the immediate recipients of this liquidity. They get this new money, this antique gold water, at almost zero interest. It's pristine, it has maximum purchasing power because it hasn't circulated yet, it hasn't raised the price of anything in the wider economy.
They are the king's friends 300 years later.
They're the privileged access point.
All right, so let's follow the water. It's in the bank's hands. Now we hit tier 2. Asset inflation, the initial splash. Why doesn't this money just immediately flow out to Main Street as, say, small business loans?
That is the key structural question. And the answer is really a mix of financial regulation and, frankly, profit motivation. These massive banks are not incentivized to go out and make a million small, high-risk loans.
It's inefficient for them.
Very. They look for efficient, large-scale, secure ways to deploy that capital.
Which means?
It means the money flows almost instantly into financial assets. They lend it to hedge funds, to large institutional investors, to private equity firms, to multinational corporations. And what do those entities do? They use that cheap, readily available capital to buy up existing assets.
Stocks, through buybacks.
Corporate bonds, entire portfolios of residential real estate, venture capital deals,
Right.
Everything that offers a potential return.
And that first massive flow of money, which is localized entirely within the financial system, has an immediate effect.
It immediately drives up asset prices, the stock market soars, bond prices inflate, institutional capital floods the housing market, locking up supply and driving prices beyond what a normal family can afford.
And this is the initial splash. The people in tier 2, the asset owners, they feel dramatically richer almost overnight. Their net worth on paper just explodes, not because they created anything new, but because the very unit of measurement, the dollar, has been expanded and directed right at the things they own.
That's the first, the fastest, and the most significant phase of inflation. And critically, it's the phase that's almost completely ignored by the official inflation metrics like CPI.
Which we'll get to. So then we move down to tier 3, secondary spend, the trickle. This is when the newly rich from tier 2 start spending some of those massive paper gains.
Exactly. When a billionaire's portfolio jumps by 40%, they don't just go out and buy an extra loaf of bread.
No.
They buy a second home in Aspen. They commission a super yacht. They hire a personal chef. They fund a massive renovation. This is where the money finally starts to trickle out of pure finance and into the high-end services economy.
Okay, so the employees at the high-end architecture firms, the bespoke furniture makers, specialized lawyers, luxury travel agents, they start to see wage inflation or bonuses because their customers are just flush with cash from those tier 2 asset gains.
Correct. It's a very localized and indirect benefit. This spending boosts these very specific non-essential sectors first. The water is filtering down, but it's still moving through areas with high prices and high margins.
It's still relatively clean water, but it's starting to pick up some sediment.
That's a good way to put it.
And now we reach the bottom of the waterfall. This is where the vast majority of people, probably most of our listeners, reside. Tier 4. The sludge. The runoff to wages in Main Street.
The flow to this bottom tier is the slowest. It's delayed by months, often by years, and it arrives mainly through, generalized labor demand or these marginal delayed wage adjustments. But you have to look at the state of the water when it finally gets there.
The purchasing power is just gone. It started as antique gold at the top, but by the time it reaches a typical worker's paycheck, it is this dark, viscous sludge. It's completely contaminated by all the inflated prices caused by the spending in tiers 1, 2, and 3.
The invisible theft is now complete. The worker gets the money last as a delayed and often insufficient wage increase, but they were forced to pay the higher prices first.
Their rent is higher because institutional buyers drove up housing prices in tier 2.
Their groceries are more expensive because input costs and wages in tiers 1 through 3 all filter down. This is the structural mechanism by which the system is, quite literally, stealing your time by devaluing the currency unit you trade your life's labor for.
The wealth transfer is baked right into the plumbing.
It is. And this detailed structure, this waterfall, it explains perfectly why your productivity gains, or just working harder, why that no longer seems to correlate directly with upward mobility. Not if you're only selling your time for a currency that's designed to flow away from you and into assets. So now we have to move on to section 3, the evidence. We've laid out the mechanism, the plumbing. Now let's audit the data and see how this Cantillon effect actually shows up in the numbers.
And before we get to the numbers, we have to address the main form of misdirection, which is the government's total reliance on the Consumer Price Index, or CPI.
Right.
This is the official metric for inflation, but as our sources argue, it is, by its very design, an incomplete picture.
It's highly misleading. I mean, when the Fed or the government comes out and says inflation is 3%, they were referring almost exclusively to CPI. And what CPI measures is the price of consumer goods and services.
The stuff in Tier 4.
Exactly, the sludge. It measures milk, gasoline, used cars, T-shirts.
So what does it strategically leave out, or at least minimize?
It largely excludes or uses these heavily manipulated proxies for the very things that actually build wealth and drive long-term inequality. Doesn't really track the price of stocks, of bonds, of private equity. And crucially, for housing, it often relies on this thing called owner's equivalent rent, or OER, instead of the actual soaring prices of homes that people are trying to buy.
So if they included the inflation of assets, the price explosions happening in Tiers 1 and 2, the real rate of monetary debasement would be
What? It would be astronomical,
Whoa.
and it would expose the Cantillon transfer immediately for everyone to see.
Okay, so let's bypass the official narrative. Let's do our own forensic data audit. If we look at the last decade or so, an era just dominated by quantitative easing and low interest rates, the Cantillon gap becomes incredibly stark. We're comparing the growth of the downstream container, which is wages, versus the upstream containers, which are assets.
Let's look downstream first. Wages. Over the last decade of these continuous liquidity injections, average wages, they've really struggled. They've risen maybe around 30%.
Which sounds okay in a vacuum.
It does, but it's a marginal gain that's perpetually lagging behind the real cost of living. This is that slow drip at the bottom of the waterfall that has already been diluted by everything that happened above it.
Now let's contrast that with the assets in Tier 2, the ones that got that initial splash of fresh money. The S&P 500, the index for big corporate stocks, has appreciated roughly 200% over that same period.
And housing prices, driven by that cheap leverage and institutional capital, have surged 100%, sometimes even more in major markets.
The numbers are just staggering when you put them side by side.
They illustrate the sheer power of this Cantillon vector. If you were positioned in corporate stocks, you multiplied your nominal wealth 6 to 7 times faster than someone who was just relying on their labor income. And that difference, it's not just because of good business performance, it's because of the directional flow of newly created money.
And then you have the extreme examples. Assets with verifiable absolute scarcity, which act as perfect sponges for inflation. Our sources point directly to Bitcoin, which over that decade saw an appreciation of around 10,000%.
That 10,000% gain is the clearest possible visual proof of the Cantillon effect in action. It's seeking out a fixed, scarce container. When the money supply expands that rapidly, the assets that simply cannot be replicated, the ones with perfect inelastic supply, they absorb that new liquidity most efficiently.
It creates what you called an everything bubble for the rich.
While the non-asset owning class just sees their purchasing power flatline.
And the conclusion from this data is unavoidable. It is mathematically, structurally harder to achieve those generational milestones, like buying your first home, than it was for your parents or grandparents.
The house is an upstream asset. And if you're running on wages alone, you are on a treadmill that is moving backward at 10 miles per hour. Your labor is in direct competition with freshly manufactured capital. This systemic pressure is why inequality isn't an accident. It's the designed outcome of this specific monetary architecture.
And this whole mechanism becomes even more pronounced, almost violent during a crisis. This leads us to the analysis of the K-shaped recovery. When the economy hits a rough patch, the Cantillon flow acts like a wedge, driving society apart.
Yeah, think back to the 2008 global financial crisis or the pandemic crisis in 2020. In both cases, the government and the central bank deployed absolutely vast immediate liquidity injections to prevent a systemic collapse.
And the recovery immediately split into that K-shape.
The top arm of the K just shoots straight up.
And who is on that arm?
That arm belongs to the asset owners, the shareholders, the large corporations. The freshly printed money, which is deployed in the name of financial stability, gets injected instantly into financial markets. It props up bond markets, it drives up stock valuations. They don't just recover their losses from the crisis, they see their portfolios multiply exponentially.
All thanks to that Cantillon flow being directed their way.
Meanwhile, the bottom arm of the K goes relentlessly down.
And these are
the renters, the service workers, and critically, the savers. They suffer the initial shock. They lose their jobs, their hours get cut. Then, as the printed money starts to filter down, they face surging costs for essentials. Rent, food, energy, all without getting adequate wage increases. They get hit twice.
So they get the economic pain first and then the structural inflation later.
It's a double blow. And this proves that the Cantillon effect is the fundamental engine that drives that K apart. It's not some mysterious market force. It is the observable mechanics of financial plumbing, turning a supposed stimulus into a massive, immediate transfer of wealth.
It transfers purchasing power away from the saver.
Whose cash is being diluted by this inflationary flow?
And gives it to the leveraged investor and the asset owner.
Who benefit from those appreciating assets and the cheap cost of debt?
Okay, wait a minute. We've made a very strong case that this system creates extreme inequality. But we have to address the counter-argument. Mainstream economists, especially those at the central banks, they defend these policies. They say QE and liquidity injections are absolutely necessary. What's their justification?
That's a vital point to bring up. Their argument, in a nutshell, is that while these policies do have unfortunate side effects like asset inflation, the alternative is infinitely worse.
Which they see as what? A total collapse?
A catastrophic credit freeze, deflation, mass unemployment, a total economic collapse that would harm the poor and the middle class far more severely than the current system does. They see the Cantillon effect as a necessary evil. It's the price we pay to maintain overall systemic stability and prevent another Great Depression.
So we're analyzing a system where the cure for a financial disaster just so happens to inevitably favor the asset-owning class, even if the stated intention of the policy is stability for everyone.
That's right. The data confirms the directional bias, regardless of the stated intentions.
This brings us to the final and maybe most important stage of our investigation. Section 4, the verdict and the upstream playbook. Given all this evidence that the Cantillon effect is a structural, physical force in the economy, what's the inevitable conclusion for your personal financial strategy?
The conclusion, based on all the forensic evidence we've laid out, is it's sobering, but it's essential. You have to accept the mathematical reality of the situation. You cannot stop the printing process.
It's too late for that.
The modern structure of government debt, the trillions and trillions owed by governments all over the world, it requires constant refinancing. It requires continuous liquidity from central banks just to keep the lights on. If they were to truly stop, the whole system would face immediate sovereign debt crises and a widespread credit collapse.
So, with that as a given, the forensic conclusion on traditional cash savings as a way to build wealth is pretty grim.
Cash, the dollar bill, the number in your bank account, is the sludge at the bottom of the waterfall. It is the primary victim of this entire process. Every single dollar you hold today is a promise of purchasing power that will be intentionally and systematically devalued by future printing.
You're sacrificing your finite time and labor for a debased unit of exchange.
Which leads us to the final, and I think brutal, verdict. Saving your way to wealth is mathematically impossible in a Cantillon system.
It's structurally prevented.
It is.
Yeah.
The new money flows consistently to the upper tiers, inflating the cost of the things you need to buy a house and education long before those same units of currency have a chance to reach you as a wage increase. Your treadmill is simply moving faster than you can run. You are, in effect, subsidizing the asset owners through the constant dilution of your own savings.
So the only viable response is to adopt what we're calling the smart money playbook. You have to position yourself upstream. If you can't change the direction of this gravity field, you have to climb the mountain to catch the flow closer to the source.
And rule number 1, which comes directly from that waterfall analysis, is completely non-negotiable. You have to stop saving in cash.
Long-term savings, you mean?
Yes, your long-term wealth. Cash serves only as the medium through which this invisible theft is executed. You need to find containers that preserve or, ideally, appreciate in value during these periods of monetary expansion.
Which brings us to the core of the counter strategy. Rule 2, buy scarcity. You have to own things that cannot be printed.
This is the big shift. It means transitioning your savings into hard assets that are positioned to catch that Cantillon flow first. Let's get specific. Our sources point to 3 main categories. First, real estate. It's a leveraged asset. You can control a large appreciating asset with a small down payment. And its supply is critically inelastic. You can't just print more land in desirable locations. So that Cantillon money flowing into Tier 2 drives up your property value.
Second, gold.
Gold is the ancient, unprintable money. It doesn't offer yield, but it serves as a pure hedge against the debasement of currency. When people lose faith in the paper dollar because of massive printing, they flee to gold as this immutable non-government store of value. It's an essential safety valve.
And third, the ultimate modern example of provable scarcity.
Bitcoin. Bitcoin has an absolutely fixed supply cap of 21 million units. That's it. It cannot be changed. It is the perfect container for this inflationary vector. Since its supply cannot be manipulated by any central bank, the expanding supply of dollars is forced to bid up the price of the existing fixed units of Bitcoin. That 10,000% gain we mentioned earlier, that's the result of Cantillon flow seeking out perfect digital scarcity.
The logic is clear. If the injection of new currency is a given, you have to make sure that currency flows directly into the value assets you hold, rather than just flowing into the price of the goods you need to buy. It's purely defensive positioning.
And finally, that brings us to Rule 3, which is probably the most counterintuitive for anyone raised on a traditional savings mindset. Use good debt.
This is a huge mental hurdle for a lot of people.
It is, but it's the cornerstone of the upstream strategy. The wealthy understand this implicitly. Inflation pays off debt. If you are positioned upstream, you are borrowing cheap, future-diluted dollars to buy assets that are appreciating rapidly because of that very same Cantillon flow.
Can you make that more concrete?
Sure. Let's say you take out a 30-year fixed-rate mortgage to buy a house. The loan is cheap, the rate is fixed. The house immediately starts absorbing the Cantillon flow, appreciating, let's say, 10% a year.
Meanwhile, your monthly mortgage payment of, say, $1,000 remains fixed for 30 years.
Exactly. But the real purchasing power of that $1,000 payment goes down every single year because of the constant currency dilution.
Right.
You're winning twice.
Your asset is going up in price, but the real burden of your debt is being inflated away by the same mechanism that's harming the person who's just saving cash.
You're effectively shorting the dollar. You're using a fixed liability, the debt, as your vehicle. This strategy completely reverses the flow. You leverage the systemic force to your advantage. The person who avoids all debt and just saves cash is financially punished, while the person who borrows cheap money to buy scarce, appreciating assets is structurally rewarded.
And that brings our investigation to a close. The Cantillon effect isn't some historical theory, it's a gravity field. It's actively operating today. It crushes those at the bottom who stick to outdated strategies like pure cash saving, and it relentlessly lifts those who understand the mechanism and position themselves at the source.
Recognizing this structural reality is really the first step toward genuine financial resilience.
Yeah.
You have to choose today whether you're going to remain downstream and, drown in the sludge, or whether you're going to execute the upstream playbook and position yourself to drink from the source.
And as you reflect on the evidence we've laid out, the mathematical bias toward the asset owner and the systematic devaluation of wages, it leaves us with one final provocative thought for you to consider. We've established that the Cantillon effect is a form of systemic wealth transfer built right into the mechanics of our money. The question is, do you see this mechanism as a necessary evil required by central banks to prevent the infinitely worse fate of a total credit collapse and deflation?
Or do you see it as simply a form of systemic theft, an inequality machine that is built irrevocably into the very structure of our modern monetary system? Your answer to that question really dictates whether you believe we should try to change the system or simply learn how to position yourself within it. Thank you for joining us for the deep dive.